So for 2020, capital gains, cash flow boost, dividends, interest earned, JobKeeper, partnership, trust income. We've got sales, purchases, we've got a whole heap of costs. We've got general pool depreciation. Now, this would typically be a full write-off. Income tax expense, superannuation, entertainment I mentioned, right? So 71002. On the balance sheet, things of interest that might affect our reconciliation, superannuation, right? Noting also that under settings and depreciation, I've said that we're using an external depreciation module. Maybe that's manual, maybe that's Excel. Let's activate our company tax return for the year. We've got all the activated components. I'll activate depreciation, should actually activate straight away, but if you have to just activate, because we know that we've got depreciation to report. Let's have a look in here now. So these are everything in here for a company, 71002, you saw me mention that number. That's after the income tax expense, right? Everything in here is exactly as per that profit and loss. So whatever you saw in the profit and loss, these are all accounting values that are coming in here. These are all accounting values, partnership, trust, etc. And then there could be reconciling adjustments. Now notice that we've got partnership, trust, dividends. In all cases, we have to say whether there's a gain or an increasing or decreasing adjustment, which would be resolved by reporting like this. So we're going to say test, and we're going to say 2,500. I just want to show you, I'm going to stay with this one. I'm going to stay with the partnership, and notice that with the partnership there's no, as a result of reporting a tax value the same as the accounting value, there's no increase or decrease, and that'll become apparent in here. So there's no increase or decrease as there is with dividends, interest and trust, because I haven't reported the tax values for these yet, nor for capital gains. So let's now go back and let's see what happens if we report a value which would be an increase. So let's do 2,600. And now what you'll notice is if the taxable income is greater than the accounting income, there's an increasing adjustment that will reflect in the reconciliation module. So there's an increasing adjustment for partnership income. So just know that you're either going to have increasing or decreasing adjustments for partnership, dividends, interest and trust, and also capital gains is always going to adjust out because it works slightly differently from a mechanical point of view. So let's resolve the capital gains. I'll put in exactly the same amount. So let's say it's shares. There's no discount, no capital gains discount in a company, right? So our net capital gain is the same. So the net capital gain from a tax perspective, because essentially this is how the company tax return works. It strips, so it goes less. So it adds these on and then goes less for these. And it's still going less for capital gains, right? But at least now you understand what's happening with dividends, interest, trust, and I can resolve those also. They're exactly the same, bearing in mind that currently there's that $100, right? That increasing adjustment. So let's just make these all the same so the thing is a little bit more simple to understand. So now you can see there's neither an increase or a decrease adjustment. And we'll do the same for these other things. So we'll also just call this, doesn't really matter in this case because it's just a demo, right? So I'm just putting some dummy numbers in here so you can understand what's happening. And I think for trust, 2,500. So 2,500, no increase or decrease. Same for interest, 34. And same for dividends. Let's do them all as franked. Now, if you have franked, you can have franking credits. So let's just say that was 600. Probably not the right amount, but you can see again here, there's not going to be, oh, there's still a decrease. Why is there a decrease? Dividends. Total dividends. That's our dividends from accounting, right? Oh, because I put them in the wrong box. That's not very clever. Okay, so 5,000, and that should be 500 there. Now there's no increase or decrease. So now if we have a look at our reconciliation, we've got franking credits coming through because the franking credits in a company will increase the taxable income. So remember, everything in from here down to less is increasing the taxable income. So it'll be that plus these, giving us that, right? And then less these. So now we've got less, so we've still got a less capital gain of 5 because we've got the increasing taxable value as 5 there. And you can understand, if the taxable value was different to the accounting value, you'd see it reflected. Obviously, you'd see the taxable value reflected here. And if we had partnerships, trust, or interest with an increase or decrease, it will reflect as I showed you before, where the taxable value is different to the accounting value. So what are our non-deductible expenses? Super payable, you saw me highlight super payable on the balance sheet, becomes non-deductible because as at 30 June 2020, it's not paid off. And you saw me tag the entertainment as non-deductible. Generally, entertainment's not going to be deductible. So our cash flow boost, you saw me tag the cash flow boost. It's actually, in this case, non-assessable, right? Not included in the assessable income. You're essentially excluding it, along with those capital gains, which we've already treated higher up, the assessable component. And then the other deductible expense, the super payable from the comparative year, which is 30 June 2019, that was outstanding as at 30 June 2019. We can assume that that's now been paid because the balance hasn't changed, right? So, and it wouldn't matter either way. So this now becomes deductible. And what do we get? We get a taxable income which is derived from, so we're obviously starting with our profit and loss. We're starting with our profit and loss, which is and so that is our total profit before tax, 104.25. So this becomes our 104.25. Adding on these taxable income items. Yep. And then of course these are taxable income items, and this is these are non-deductible expenses. They all get added, so that increases the taxable income, and then less these values which are not taxable. So capital gain, the accounting concept of capital gain, not taxable. Cash flow boost, not taxable. And the other deductible expenses, super payable from the prior year, balance, not taxable. And therefore we arrive at a taxable income amount. Now, one thing I didn't do was I didn't put in here, I didn't put in all the credits. So let's come and put in some more credits so you can see what's going to happen. Don't forget, I'm filling in the tax values. So maybe we've got some TFN withhold. Maybe in the partnership we've got some, let's go in there and put in some credits. So maybe we've got some franking credits in there, maybe $600. And maybe the same for trust. Maybe we've got 800 or something in here, doesn't matter, just an example. But if we now have a look, our reconciliation shouldn't change because only the franking credits from company dividends would increase the taxable income. But when we look in the tax calculation, we've got our franking credits, and then we're going to have our other credits in here as well. So we've got our TFN credits, and we should have, where are our other credits? Oh yes, here we go. These are non-refundable credits. So non-refundable credits from our trusts and partnership, treated differently to the company refundable potentially refundable. Oh, sorry, and also non-refundable, non-carry forward, right? So you can at least see that everything's been calculated. The 98,225, which is the reconciled value down there, 98,225.